Right, ladies and gentlemen, morning, good night, good evening, wherever you are. Hope you have a good weekend start. So, welcome to Hummingbot Live again, another Friday, and today we're going to talk a bit about uh, probably a question I think mostly for new users that what's the big difference between having liquidity mining and on Hummingbot miner and the liquidity mine that you see on the automated market makers like on swap balancer and all these others new technologies we're seeing for the last years. Well, okay, so let me change here a bit because so just a few good news that have a good price for Bitcoin today. But the first thing I wanted to show is that something that everyone's already used to see. That's the graph. But more important than the chart here, when we're going to talk about this topic, the specific topics, is the order book. Because if you see, take a look at the order book, that's where the liquidity is. That's where we see what's the current market liquidity. And just to show, for example, we can see that there's a few options here. And it is important that if you're new to the markets in general, be it for if you're looking to do market making, if you're looking to do any kind of trading, order book is important piece of information because you basically you can see how much liquidity there is on the market, and if depending on the side of your order, if you would have an impact on the price or not. So there is a lot of information there, and it's basically the main tool from for market makers. And when you look at the automated market makers, an interesting factor that happens there is that basically there is no order book. So how do you know the market's trading at price at what price, right? So when you compare two kind of markets, this is basically the big difference, because centralized exchange on the traditional markets, you have the order book where you see on each level where's the price, how much liquidity there is on each price. For example, right now, as you can see on the 60K for Bitcoin, there is a huge amount of liquidity there, right? So there's a lot of orders. Understanding this, it's easy to see that once the price moves to 60K price, once the market moves, start to go to that direction, it will find resistance. There is a lot of people selling at the price, and you can't see this on automated market making because, as we all know, rules are different. There is no you can't add an order at specific price. You can't set your levels where you want to trade. You have to follow the rules of the right. Okay, so an important thing that we should also ask on when talk about this topic is exactly why market making. If you started trading like me on Forex, then you started to look for information about to learn how to trade, how the markets function. One thing interesting that you see is that there is a lot of articles, courses, theories, and strategies that's puts the market maker as the bad guy of the market, the guy that controls the price or something like that. The market makers are the ones who have the power to manipulate. Well, it's weird because while market makers deal with volume, lots of volume, and they kind of choose the price they are going to trade their work, and but it isn't something evil as some people I saw in some articles about, especially about forex, and it's at the end of the day what the market maker do. He provides a service, right? Because imagine this: what if there were no market traders? What would be the possibility of two different parties, two different people meet each other at the same moment in time? They wanted to trade and they agree at the exact time what's the price they're going to trade, right? So it's a pretty low probability this happened. So an image that I took from this marketmakers.ai that is actually a professional market maker firm, right? So there's no marketing. Just a good example that I found is that if you take a look at a market that have low liquidity and there is basically no market maker acting on it, what you're going to see is price moves in a weird way. For example, you can have a price level where there isn't trades, and suddenly you see a big spike on the price direction, and this happens on and on around the. If you go to a market with high liquidity, you see that the price kind of moves more smooth way, a more how do I say, in a more, I wouldn't say predictable, but in a price moves in a way, in a range that it's more it's easier for the trader or for anyone that's looking to buy or sell on that market. It's easier to see that how is the price moving, how is where people are mostly buying, where there's the price that the market participants are looking to trade. And this usually happens when there's a lot of liquidity. And you if you take a look, you notice no matter what is the market, it could be stock markets, could be crypto markets, it could be sorry, it could be sports bet markets, it could be any kind of market. You see that the price only take this kind of approach, movement, range, discovery, price discovery when there's a lot of liquidity, and usually this liquidity is provided by professional market makers, right? All right. So the question is, when you look at, let me change the mind place. Here we are. Okay, so when you look at automated market makers, that I have to agree, it's a really interesting model for price discovery on markets. Basically, what you're seeing when someone executes a trade inside the markets, yeah, you notice that what happens at the end of the day, that the guy that's doing the exchange, the trade, he's pulling the asset from one pool and adding the asset he's selling to another pool, right? So if he's trading the same asset, he's going to take the asset from, and sorry, if he's trading the same asset that the pool have, he's going to take one asset and deposit the other asset or on the pool. Sorry about it. And so what happens is that the the main market makers, the first model used by market makers, automated market makers, is where the price of the asset, right, depends on how many liquidity there is, how many units of asset there is on the pool for each one. So it kind of creates a balance as the amount of each asset of the pool moves around, right? So for someone that is providing liquidity, right, what happens is, where is it? No, this one. What happens when someone's providing liquidity to automated market makers? What he does is he adds to the pool the assets he wants to provide liquidity, and he receives back a token that represents that amount of liquidity. Right. So let's say if an asset has a pool had total value of 1 million, if someone adds 100K there, he's going to have an asset receive a token that represents that percentage of the total pool, right? So then you start to see that what happens when you have two pairs that aren't directly correlated is that from when you have, for example, one ether and one DAI on the pool, right? If a trade happens, if someone buy ether and sell DAI on that pool, what happens is going to be that the ether amount by the pool liquidity, the total liquidity of ether that pool, will decrease, and the amount of DAI will increase, right? So that guy that had the token that represent a certain percentage, let's say 1% of the pool, if he decides to withdraw back, to take back his ether and his DAI from the pool, and let's say he have 1%, what's going to receive is 1% of the total amount that there is on the pool, right? So here's where it happens, what is called the impermanent loss. So basically what means is that over time, depending on what's the price of the underlying assets that are from that pool, depending on the price that it is today, different that exists from the price that it is today, from the price that the day you deposited, this can create loss because the current price of both assets change, and the total value you're drawing based on the percentage that you have right there is going to have a smaller value compared to, right? So this is the basic of impermanent loss. There's a lot of blog posts and articles around the web to detailing a lot about it. Okay, so one interesting thing I wanted to show about impermanent loss is this, that let's say I found here a tracking of impermanent loss across different pairs, right? So this is the impermanent loss of pools that have USDC as the pair. For example, we would have Band USDC, RAN USDC, USDC. So as you can see, the impermanent loss varies a lot over time because the amount of assets change as the trades happen, and the total value that you have locked inside the pool is changing over time. But there's something really interesting. If you take down Band, RAN, Link, WBTC, and you look at the pools with USDC versus another stablecoins, USDC, USDT, the impermanent loss basically zero, right? Why? Because, well, they're pretty much the same value. What happens is that the total value inside the pool doesn't change, so it doesn't have this loss, right? So what's interesting to see is that why that happens, because as you can see on the price range inside the for example, USDC USDT pair, is that, sorry, let me take my face from here, right? What you see is that the difference price change happens in a really small range, right? And if it, but here's the thing: if you look at, for example, Ether USDT price, right? So the price changes a lot. So you have a bigger range of price, right? So okay, so here is where the interesting part gets, is that if you compare, for example, a trading pair like ETH or any kind of pair, you notice that you have a big risk of permanent loss because of the price move over time and up level. That's totally different started, and for the value you extract from. But if you execute, if you add the liquidity pool for coins or assets that are totally correlated, like two stable coins, right? What happens is that the impermanent loss is really close to zero, right? Okay, I hope this isn't the boring one, but it will make sense when I get to the conclusion. What's the difference? The interesting part here is that when you look at the pair like Ether USDT, that's the one that have highest volume. Well, you notice that since there is a bigger volume there, although you have a risk to have more impermanent loss, what's going to happen is that you're going to receive more fees because there is more volume. So the liquidity you added to the pool is going to provide more return in trading fee, right? But if you look, for example, at USDC, you reduce your impermanent loss risk, but you have way less trading fee. You receive way less trading fee. So this is an interesting situation because you are kind of have to figure out where will be the risks. So this, if you look at the automated market makers, this is the main risk that you have to decide, right? So you want to take more permanent loss risk and receive more trading fees because of that, or do you want to have a low impermanent loss risk, but at the same time receive less trading fee? All right, so I went through all this talk about the how the automated market making works, because after thinking a lot about this, what's the difference? How can we say what's the difference between you adding your funds to a liquidity pool and running a trading bot that executes market making? My conclusion, you might be a bit surprised by it, but my conclusion is that they are basically, in essence, they are the same, right? So what's happening inside Uniswap, what's happening inside Balancer, happening inside any kind of market maker, what's happening is that the funds you deposit on these protocols, you are providing liquidity. You are basically running an automated bot as a market maker. Except that when you look at what is the small difference that have a big impact if about it. If you look at, you take Hummingbot and start a market making, you deposit your funds on an exchange, you set a spread, and you do whatever your strategy do. Basically, you do the same thing, right? You are market making, provide liquidity on a market. the difference between how much you receive for that market making, for that liquidity you are providing. The big difference here is that on swap, what you receive, what you get back, your payment as a market maker is going to be the trading fees, right? But on making a market making inside a centralized exchange, what you receive, you're going to pay trading fees, but you're going to receive the result of a spread strategy, right? So if your strategy is good, if you have a good enough strategy, you set a buy and a sell order, both orders will be taken, and that spread, the difference between your buy and your sell order, is going to be your, right? So that's the big difference when you look at the profitability, how to understand where. So on the risk side, when you look at Uniswap and other automated market makers, your risk is basically the what is called generally as impermanent loss. That's translating it. Basically, it says that the risk is that when you decide to stop market making side on swap, you have the risk of the assets you're going to withdraw are going to have a value that's lower than the value when you add it, right? But when you go directly market making on order book, your risk is similar, but it works a different way because for example, the main risk you're currently doing is called inventory risk. We have a lot of articles on our academy talking a bit more about that. And what happens is that you have a similar risk where you're going to, for example, the price starts to go against your strategy. You start to only execute one side of the order. For example, if the price starts to go down, your buy orders will be filled. You start to increase your inventory on the asset that's low value, right? So that's the difference. That it's kind of similar like as permanent loss, right? So my idea is that basically they are the same. But here's the key difference, the main difference between on when you're going to decide if you want to act, if you want to provide liquidity to a market, if you're going to act as a market maker, depositing, or if you're going to run a strategy bot, a market maker. Well, a small pause here. That's only thinking about profitability of the strategy, not talking about supporting a specific project or anything besides the profitability of running a strategy, right? So I have no problem. I like a project and want to provide liquidity, want to help the project, go ahead. It's always an option for that. So let's get back to the profitability and the difference. Where is it basically? When you look at Uniswap, or any other balancer or any other market makers, Pure Finance or SushiSwap, what happened is that everyone that provides liquidity on that market is obligated, have to follow the exact same strategy as everyone, right? So what everyone else is doing, what the rules, not the rules, but the way the trade will happen will be exactly as this program protocol. So there is no try a different strategy. There is no room to change the direction you want to trade more, right? That's the thing about the. But when you go with Hummingbot or any other trading bots that the market makes, well, you have a lot of room for, right? So a big example, getting back to the inventory cost. While in permanent loss, you can't do anything like to change your position inside the pool, except adding more liquidity to the pool. When you run a trading bot, you could, for example, if the market start to trend direction, you change spread size side order. If the market, the price market starts to go up, you use your bid spread and you increase your ask spread. That way you increase your chance to buy before you sell, right? So there is a lot of ways you can, take external blockchain information, add to the bot, and it behave in a way depending on how much Bitcoin or any other asset is flowing inside and outside the exchange. So there is a huge amount of possibilities where you can create, customize, and try new things, try to adapt to the. Let me just now let me take a look at the chat. If this, so how are you guys? Volatility decrease if markets increase. Right. Yeah, audio. Sorry about the audio. Probably got a small pickup on my. So there's a question here. If you mark the prices on entry of the post, could you gauge a good exit later with less loss? Well, yeah, you could. So basically, if you take a look at the most of the articles about impermanent loss, basically the exit point, the price of exit point you do on a market, on automated market maker, should be the same as the one you entered, right? So if you entered for example, Ether at 1K, the perfect exit point of automated market maker would be at 1K when the price is back at 1K. That way you would withdraw the same value you added, plus the trading fees you receive on the period you buy the liquidity. So this is a bit hard to happen depending on the situation of the market, like what we have now. The bull market was, right? So it's basically the same risk. The liquidity provider is on the losing end of the trade when the price moves. Well, in a sense, yes, it is similar. I wouldn't say it is the same risk because the amount the amount you're going to withdraw from an automated maker will also depend on how much volume is being traded there. So if there is a lot of volume, there's a lot of trading happening, a lot more fees, so this would compensate the inventory risk, the permanent loss risk you have in the automated market maker, right? So when you go to the order book, it's a bit different because you're paying fees. So every trade you make, besides the inventory risk you have of the market going direction, you also have the added risk of paying more fees than needed, right? So there is also this. That is interestingly counterintuitive. This DeFi is actually more centralized in terms of available strategies. Well, that's true. It's I mean, the whole idea of a market maker, I think it's amazing. I think it's a really good idea because it's the first time basically that we have a high liquidity market, a high liquidity and decentralized market, right? So although there is some imperfections, and if you take a look at all the DEX project, you see there's a lot of work to mitigate this kind of risk, this kind of impermanent loss. So there is every week, every day, there is something, some new idea, protocol launching to reduce this risk. But at the end of the day, my opinion still is that no matter how much they improve the reduction of risks, at the end of the day, there will still exist this difference where if you go to an automated market pool, you are going to be subjected, you're going to employ the strategy that's written on the code. You don't have space to create new ideas or act depending on the market, right? So that's something that I think that will be really hard to provide the same, let's say, the same strategy freedom that you have on other markets, right? Okay, so jumping a bit more for the next slide. Here comes the next question. Besides the automated market maker, we saw the DeFi summer, as it was called last year. What was called the liquidity mining, the liquidity farming, yield farming, and all that new different and crazy terms that appear on the last year. And there's always something I really find this movement. So basically, when you look at automated market makers, the DEXes, even a bit more on another type of trading that would be for AVE, compounds, and any other lending protocols. And where you have the liquidity mining, that basically means that you add liquidity, you receive, besides the trading fees or the interest rate, you receive an extra reward. That is a token for usually that is a governance token for protocol. For example, we have on the Uniswap launch, you added liquidity to these pools, to these 4 pools, you would receive a part of the Oni token, right? So we, as we, the company Hummingbot started, one of the main programs we started alongside with the Hummingbot client was the Hummingbot miner. That basically is the whole idea of the liquidity mine that you see on the automated market maker. The whole idea is what made us create the Hummingbot miner, right? Because just think about it. What you do on Hummingbot miner, you start a trading bot, you add liquidity to the pool, and you are rewarded for with depending on the project, you are rewarded with tokens, be it USDT or token of the project itself, for the amount of liquidity, the spread size you have, you put there, and you are paid basically for the liquidity. There's no difference. Right? Basically the same. You liquidity, except that now you add liquidity, something that on the strategy, and you are receiving, you're getting paid, getting rewarded by with a token that's extra from the how do I say, sorry about it, you receive an extra income besides the trading fee that you give just for providing liquidity. Here's the same with Hummingbot mine, with our liquidity. You add liquidity to the pool, and usually what would happen, you will have your profit as a market maker from the spread, from your strategy, from how good is your strategy. And when you add it to the Hummingbot miner, to the programs we have, you are doing something that you were already doing, that was trading, acting as a market maker, using a bot and you're receiving a bit more for it, right? So I don't. There's no way to put it. It's the same thing. The only difference is how you provide the liquidity. So I don't think there is much for me to say about that. But I wanted to close with one small observation that it's valid both for the automated market makers, and if you're going to participate on any of the liquidity campaigns we have on a miner, that is, if you're going to provide liquidity profit on any project, no matter the project, and you are looking at the liquidity rewards and looking at them and see, oh, I might get some extra value here. The most important thing you should ask before adding liquidity to the pool or receiving the rewards or starting a market making bot receive the rewards from bot miner is my strategy good enough to receive the to be profitable without the rewards, right? Because if your strategy or if the impermanent loss in the pool isn't big enough, it isn't good enough, if you're going to provide liquidity to a random coin that you never saw in your life that launched yesterday but is promising 2000 yearly percent of liquidity rewards. So is that project good enough long term where I want to have my assets, my inventory tied to the project just to receive a supposed reward? Well, I don't know. That's up to you to decide, to look at the project, understand the project, and the same works for miners. So if you're going to start a bot, start a strategy. So if a strategy, market maker strategy, it isn't good enough, it isn't profitable, you're probably going to lose money, and what's going to receive from the rewards won't be good enough. So for that, we have our Discord chat, we have the trader chat, we have a lot of talk there, creating ideas, and there is no other easy way to say this. There's no magic formula, simple configuration or strategy. It needs a bit of grind and study. We have the academy where we have a lot of articles and studying more there. And well, you have to learn about market making and how the market works, and start to try, test strategy, take a look, see if the and then when you are confident, you start your participation, add more volume to your liquidity providing, and get better reward. Then you also get a profit from your right. So well, that's it. The same would happen to a token. So I'm going to add liquidity to a pool of unknown token, probably have its value go next week. Well, won't, right? I don't think anyone is. Well, you could ape it to try to make some crazy quick profit, but the long term you probably would, right? So yeah, well, I think that's it. What I have to say today. Let me see if I have anything else to this topic. And so, any new questions? Anyone ask something? I don't think so. So there is the BAO token. Yeah, they created a BAO coin board. Oh, it's on our GitHub. So developers, look at it. It's an interesting one. I have explored the BAO project a lot, but I have some try to see how it goes. So, well, I guess that's it. As always, we are now Discord. So, another question. Whoa, before we go, nice. When liquidity mining, do you tend to focus more on placing orders that will rewards, or do you try to profit from the actual buys and sell and use the? Well, I would say that the second is more productive, right? So here's the thing. Here's an interesting thought, right? Let's say usually our liquidity mining programs have a maximum spread where you would be able to receive the reward, right? So usually it's 2%. But let's say you want to provide liquidity, but you want to avoid execute trade, right? Basically, you don't want to have the risk of a wrong. So you do what? Put on the far away market price possible, not few, right? That's the basic idea. But if you do that, you won't receive good enough rewards because you are too far away from the price, and as the price moves, you are off the 2% range. So my suggestion would basically be try to figure out a strategy, a market maker strategy, not necessarily that provides a really big profit, but that at least provide less risk, right? So if you're starting now with bot, so my suggestion is basically to try to figure out how to reduce the risk, not necessarily increase your profit. So if you understand how to reduce, then eventually you're going to have your orders filled, and the trade will cover the exchange fees, right, and the reward, the bonus, what you're doing. All right, that's it. I'll wrap it up here. Sorry about my stuttering today, but yeah, find us on Discord. We're always there. We have 24-hour support, and well, we are probably launching next week the next iteration of our bot, if everything goes as let's us hope so. I don't see we have new. And well, see you around next Friday maybe, if I'm the one. I'm not sure, but okay. So before we go, no example. What do you mean by no example of running a bot? Live bot? Yeah. Well, sorry, I didn't. I didn't got any bot ready. You can check the lives. Have some strategies, including the strategy on the last Friday we did. The strategy that's based on a scientific paper, market maker scientific. Well, sorry about that. I'll try to have a more another demonstration for you guys. Right? Bye. See you around, and good trading for you.